What's up, world? Michael EJ coming to you once again with another video. Usually talking about different things pertaining to finance, business, and life. And today, a little bit of finance and business, a lot more finance. I want to actually talk about the Nike Amazon partnership that is expected to happen going forward, that Nike announced during their latest earnings call at the end of June, and just talk about what it really means to their valuation, as well as to how it affects the overall industry and companies that are connected to Nike. Now, how did we get here? How did this become a problem? Well, there are two main sources of that. First is Nike, very protective of their brand. They started to notice that counterfeit Nike shoes and apparel is being sold by third-party vendors on Amazon.com. That's a problem. I mean, Amazon is a great way to reach different people. They're probably one of the most well-known ways to actually connect to customers. And before the partnership, Nike they wanted to focus on their own direct-to-consumer line, their own segment of e-commerce. But this other segment that's opened up, if there's continuous problems with it, with counterfeit shoes and people, just a lot of thieving going on and just a lot of problems, and Nike wanted to protect those things. And they do want to continue their own momentum in terms of their direct-to-consumer sales, but they want to do it in a certain way. They at first relied a lot on their two main retailers that are connected to them, which is Foot Locker and Finish Line. They kind of take up the bulk of the work in terms of shoes, and they've done a decent job, especially Foot Locker. It's still growing at a decent clip, but it's not growing fast enough. That's the thing. The growth isn't there as much, especially for a company like Nike that is a growth stock, although they are a very mature company if you really look at them. So they also wanted to use a different resource. They realized that, we're looking at counterfeit Nike shoes on Amazon, but Amazon just continues to build on different momentum. It's the place most shoppers go to. Why focus so much on our own platform on Nike.com? Instead, let's partner with Amazon and see if we can reap the benefits and control our own brand while at it. So, with that in mind, to me, this is a major shift in Nike's story in terms of valuation. What their value is and how do you explain their value going forward? So before the partnership, let's break it down to three levels: revenue, free cash flow, and returns on invested capital. Before the partnership, short-term revenue growth, mainly driven by the emerging markets in Greater China. That's just going to continue to drive things. That's what's been driving them lately. No change there. And direct to consumer sales continue to rise rapidly, growing at about 15% plus clip. Pretty good. Free cash flow, paying attention to it in terms of margins and in amount of investments needed. Margins will continue to slightly decrease. They've been on this trend of slightly decreasing margins. And it's mainly because of continuous marketing spend, as well as an increased investment associated with their direct-to-consumer segment. And you combine the slight decreases in margins with they're still selling about the same amount of shoes, maybe a little bit more, but it's being matched by higher reinvestment rates. Return on invested capital may actually decrease a little bit. It's still far above what their cost of capital is, at least in my opinion, but there is a decrease there. After the partnership, things are a little different. Similar expectations short term, mainly because of a cannibalism effect. I expect as Nike wants to sell more on Amazon, they're going to sell less on their own platform. So short term, we can have some budding kind of cannibalization happening. But long term, it does help. It will help increase revenue in the long term. Free cash flow with less pressure on their own DTC segment, Nike could potentially keep margins flat, even increase them a little bit by just simply relying more on Amazon. Now, you don't want to give too much power to Amazon, but giving them a little bit of the power can help, especially since you're looking to cut overhead and cut off operating expenses anyway. So instead of declining margins, you have more flat margins and increased turnover by being able to sell more shoes in the long term by being on the Amazon platform and controlling your presence on that platform, can actually lead to return on invested capital staying where it's at. So let's play this out in terms of valuation. We use 3 different valuation metrics. First, PVGO, my personal favorite. Second one is actually the Gordon growth model, but instead of using dividends, we're going to be using free cash flow. And the third one is a fundamental kind of invested capital multiple. Similar to how you will build the price to book multiple, fundamentally with returns on equity. Do the same thing with invested capital, but we're just going to use the returns. So first, let's start with the PVGO. Estimated before the partnership at about 25%. The highest you can have for what I would say is a true mature company. I see them as a true mature company. I mean, and I can't make a compelling reason before the partnership to rise above that. So just based on that, no growth value at 65 billion. You multiply 1.33 by that 65 billion, you get approximately 87 billion in firm value. Equity value is about 99 billion. After the partnership, I can make a case to give them a little bit more wiggle room in terms of the PVGO. Not that much, just a little. I'll bump them up a little bit. This does add value. This adds another valuable source long term, and I can't deny it, as well as controlling your own brand. One of the major things is intangible assets when it comes to growth opportunities and true fundamental growth. So, Nike's hitting on all fronts in terms of this. So, because of that, I'll give them the 30%, bump up the multiple a little bit, raises up their equity value to about 105 billion. Now, let's look at the Gordon growth model. 1 year out, I see revenue growth at about 4%. Free cash flow margin is about 9%. Right now, it's in the 10-11% range, so a slight decrease. Long-term growth is about at 3%. And looking at the cost of capital down below, it's about 7%. And, see the equity value being about 94 billion. Once again, not too far off. It's not that far away from where they're valued at now. But let's make a little bit of an adjustment. Let's keep 1 year revenue growth constant, like I've said. Let's increase free cash flow a little bit in terms of margins, and let's increase slightly the long-term growth rate. And that leads to $116 billion in market cap. A good increase of in excess of 20 billion. And that's a nice increase in value from one partnership. Let's look at the IC multiple right quick. We got a terminal return on invested capital about 23%. Right now, with certain adjustments I've made, I calculated closer to about 25%. So a slight decrease like I mentioned before. Long-term growth rate still 3%. Comes to a multiple about a little bit over 5 times. And estimated equity value is about a little bit over 120 billion. Now you look at the partnership and how things change with increased turnover, which is a major component to returns on invested capital. Keep returns on invested capital at historic levels at 25%. Slightly increase the long-term growth rate and increases the multiple to about 6 and some change. And now we go from 121 to about 147. These are some big changes I am talking about here, guys. Big changes. So let's just wrap it up in terms of an investment summary. Estimated price today, at least to me, is about 105 billion before the partnership, it's valued at about 99 billion today. So it's in range. It's properly valued. And if you consider what I would see as the 5-year expected rate of return from the fundamentals, most of that coming actually from shareholder yield, so dividends as well as share buybacks, and you add a little bit of a multiple effect, and I just see an 8% return expected rate of return in terms of the fundamentals over the next 5 years. And for me, for myself, I want to see stocks that can potentially double in price, fundamentally speaking, over the next 5 years. And although slightly undervalued or fairly valued today, it's not growing enough to really catch my attention. I mean, it's really lacking. But after the partnership, things change a little bit. Although I don't see them growing and doubling in terms of market cap over the next 5 years, I can see enough of a difference in the short term to want to invest. I mean, I see it 25% undervalued today, slight increase in expected rate of return. That makes it more of a bang with my buck. I mean, to me, this changes the game overall and turns me from a Nike's slightly overhyped to you should be trying to buy some Nike stock right now. Now, how does this affect things for both Foot Locker and Finish Line? Well, I mean, there's some equity research analysts out there that doesn't think it will really affect Foot Locker. It's going to affect Foot Locker. Let's be honest. Come on, how can it not? 60 to 70% of all of Foot Locker sales come from Nike products. And yes, the most important of that is the House of Hoops concept, which will not be messed with. Bear in mind, I'm not saying House of Hoops is going to be the problem. I mean, the customization that goes into those stores, that partnership is very valuable, and it attracts more of the basketball crowd. I know a lot more people who play basketball in the AAU scene, and just in general, they'll actually go to Foot Locker before they go to an actual Nike store, or go footlocker.com instead of Nike.com. That's how much Foot Locker is connected to that group. And that's basketball. Everything else is up in the air, especially in terms of apparel and running shoes. Foot Locker isn't as connected with Nike because in those terms. So it's going to affect them. All those marginal sales from those other items, they won't be coming through Foot Locker in the long term. Now, in terms of Finish Line doesn't have as strong of a relationship, but they still depend on Nike pretty much the same amount as Foot Locker. Finish Line, they got more in bed with Macy's. I am totally bearish on them. I see them just cradling. I don't care how things have turned around recently. I mean, the continuance divestment that's been going on, they just can't turn things around. They just made the wrong bet. They got in bed with the wrong company. And I just can see that continue to manifest itself. And this partnership just makes things worse for them. So at first, let's take a look at Foot Locker. Let's look at the before and after comparisons. PVGO, Foot Locker, they're still malls. I'm bearish any mall concept. Maybe if you're part of the Tinder outlets or something, maybe. But if you're not part of that, if you're in a regular mall, no. I don't care how great the House of Hoops is. I see some decline going on. I do not see that as a viable business strategy going forward. So I actually have the PVGO percentage estimated at negative 10%, slightly below. Leads to a multiple of 0.9. Still a good no growth value. And let me just make this clear. Both Foot Locker and Finish Line has healthy margins in terms of free cash flow, in terms of operating margins. They're actually a little bit better than Nike, but also Nike is actually doing the production. Foot Locker is kind of the middleman. They buy wholesale, sell it retail. So they don't necessarily have to deal as much with advertising, as much as marketing, as much with the first mover advantage. Well, disadvantages. So it helps them both. But in this situation, it's gonna hurt. It's gonna hurt not controlling your destiny. So PVGO overall, I see it at estimated market value at about $9 billion before the partnership. Afterwards, slight decrease. All those marginal sales that would go to Foot Locker, I don't see going there anymore. Over the long run, so an decrease of about $1 billion to about $7.7 billion in terms of valuation. Gordon growth model with free cash flow. I see 1 year growth, minimal 2%. Not, decent margins. Long-term growth very low. And estimated market value about $9 billion and some change. Now we're going to decrease the revenue growth even more and not even see long-term growth. I don't just seeing problems overall. It might be the end. So in terms of growth prospects, so I see a huge decline in terms of the Gordon growth model of about $4 billion to about $5.5 billion. And in the IC multiple, still in both situations, still very high return on invested capital, about as high as Nike, even with less expenses and less revenue. Long-term growth, low both sides, but 1% growth versus 0% growth is essentially the difference. And that makes all the difference from being worth about $9 billion to maybe about $6.5 billion. Now, having that play out in terms of investment, before the partnership, definitely would have gave Foot Locker a look. I've always been fond of the company. And although it might not be the best investment long term, in terms of that 4 years, it would have been great because it's really undervalued, about nearly 50%. And if you had the right catalyst, maybe some momentum in there in terms of stock price, totally would have invested. Totally would have been worth it. Now, after the partnership, not as strong. It turns to me more like it's fairly valued. It went from clearly undervalued, maybe not the growth prospects there, but it's clearly undervalued today to growth prospects aren't there. Still not there, and they're fairly valued. Not worth it. It's like the reverse of what I was seeing with Nike. Beforehand, not enough growth. Afterwards, way too undervalued to not pay attention. Flip-flop here. And as much as I love the company, wouldn't invest in them right now. Finish Line, oh, it's bad. It's bad. I have no faith in Finish Line. No faith. Bad strategic moves, questionable management at times. I see the wheels falling off. And you know what's surprising? Because they have a decent free cash flow margin, and decent returns on invested capital, even with a very high cost of capital, very high because of a lot of the hidden debt in terms of operating leases off the balance sheet. But still, even with all of that, they're still worth about $1 billion after all that. Once you average all three, they're worth maybe a little bit less. Estimated PVGO being that low, it still doesn't matter. Negative growth rates doesn't hurt them. They generate enough free cash flow. Cash is king, and I can't ignore that. But after the partnership, things just go downhill even more. More negative growth in terms of PVGO percentage continuing to lose value, growth decay. Less revenue growth, less long-term growth rates. Lower returns on invested capital, doesn't even come close to what I think the cost of capital is, and it kind of just knocks them down a little bit. Just overall, well, they've already been knocked down. I'm not trying to stomp on them, but I'm just saying. So, before the partnership, you can make similar to Foot Locker. You can make a case. They're very undervalued, and although long-term growth prospects don't look great for them, with the right catalyst, maybe some momentum in the stock price, totally worth an investment. But after the partnership, no. And by the way, still grossly undervalued based on free cash flow. Still grossly undervalued. 30% off. But I see negative growth happening with this company. I have no offense, Finish Line. I have no faith in you guys. I have no faith. And I know you think guys been trying to turn things around, but I guess you're just in the wrong industry. Just in the wrong industry, wrong place at the wrong time. It's the best way I can explain it. And it turns from a maybe, probably not, no, to a hell no. So in conclusion, this partnership greatly benefits Nike. Turns them from a maybe Maybe just they're fairly valued to a downright renter. Like, you should be investing in Nike. They're large enough. They control their market anyway. You should just be looking at this company and really put your money there, park it for the next 3 to 5 years and see what happens. They're going to be able to control their brand a little bit more. They'll be able to increase turnover in inventory, sell more, especially things that they want to sell at a lower price. And, I mean, they don't have to focus on their own direct-to-consumer segment as much. I mean, and it hurts their shoe retailers. It hurts Foot Locker and Finish Line, two valuable partners. But at the same time, I mean, they're in questionable business segments already. I mean, business viability is a concern for both. More so for Finish Line, but Foot Locker too. We're just going to increase a little bit more with this partnership. So that will do it for today. Any questions, any concerns, any situations you'd like me to look at? Holla at your boy. I mean, there's a lot of companies out there that are interesting, a lot of situations out there that are interesting. Situations like this, maybe just changes in stories. Always pay attention to a change in the narrative of a company. You'll be surprised how it affects the value. Until the next time, peace.